Hi, and welcome to the Introduction to Financial Statements video series. This is the second in the series, and we'll look at the income statement. The series is written and narrated by Professor Elizabeth Keating and produced by Yasmin Mazen. There are three key financial statements that most firms produce. The first is the balance sheet, the second is the income statement, and the third is the cash flow statement. In our first video, we looked at the balance sheet. The balance sheet's goal is to describe the assets, the liabilities, and the equity of the firm at a particular point in time. The balance sheet is structured based on a particular equation. Assets are depicted on one side, and they must total and equal the sum of the liabilities plus the equity. The assets are the things we own of value. The liabilities are the obligations and debts we have to others, and the equity is the contribution of resources made by the owners of the firm. In a future video, we will look at the third statement, the statement of cash flows. Its goal is to summarize the cash movements by purpose during a period of time. That statement is divided into three key sections. It looks at the operating activities of the firm, the vesting activities, and then finally, the financing activities. In today's video, we'll be looking at the middle statement, the income statement. Its goal is to describe the revenues and expenses of a firm during a period. There are many different ways to prepare financial statements. In this video series, we are going to be taking a view that we are looking at a for-profit company whose goal it is to sell goods or services. We will be following the rules as must be followed by firms within the United States, and in particular, we will be following the rules required of publicly traded firms or firms that wish to be audited. The rules they must follow are called Generally Accepted Accounting Principles, or GAAP, and these rules are created by the Financial Accounting Standards Board, or FASB for short. The fundamental relationship underlying the income statement is that revenues minus expenses gives us net income. This relationship compares revenues, which is income earned by the firm, to expenses, which are what is called incurred by the firm, to generate net income. If the revenues exceed the expenses, that income is positive. If the expenses exceed the income, then we can have a loss. There are many terms that are used for the income statement. There's the income statement, the statement of operations, the profit and loss statement, the statement of revenues and expenses, and the statement of activity, the last one being common in nonprofit organizations. So now let's get a better sense of what these terms mean. Revenues is the incomes generated from the operations of the firm during a certain period before any costs are deducted. So if we have a sale of some items for $10,000 that cost us $6,000, the revenues are the $10,000. An important concept that goes with revenues is called the realization concept, or the realization principle. The idea here is that a revenue can only be recognized after or at the time it has been delivered or rendered. The other key concept on the income statement are expenses. These are the costs associated with generating the revenues. An important concept or principle that goes with expenses is called the matching principle. What that says is that you recognize an expense in the same period as the associated revenue. So in the example I just described of selling an item for $10,000 that cost $6,000, the $6,000 in cost should appear on the income statement in the same period as the $10,000 in revenues. In addition, suppose there are supplemental costs, indirect costs, such as rent, insurance, and utilities. Those costs are assigned to the appropriate period in which they were used. So we looked at the balance sheet in the last video, and now we're looking at the income statement. And the question might be, how do these two statements relate? The balance sheet is a quantity, a schedule of quantities. And one of the quantities that's there is the equity, the amount of resources that the owners have given the firm. One of those equity accounts is called retained earnings. So you can see depicted in this graphic of a bathtub the quantity of resources provided by the owners with the label equity. One of the main ways that equity increases is through revenues, and you can see that as the inflow from the spigot going into that first bucket. And one of the main ways that equity decreases is through the costs that are incurred or expenses, and you can see that depicted in the outflow coming out of the bathtub into the bucket labeled expenses. So now let's look at the various forms of revenues. Essentially, there are four. The first is the selling of a product from inventory. The second is the rendering of a service. These two categories are the most common. You will also find those firms that make money by permitting others to use an asset, such as they're using extra money, taking out a loan, using a fixed asset, or using a patent or a trademark or some other form of intangible. And the fourth and final category is the selling of an asset that the firm owns other than inventory, such as a financial asset or an unwanted fixed asset. So here's some things you should know about selling a product. The firm is selling to a customer. In exchange of a product, they receive some form of compensation. That doesn't have to be cash. It could be in the form of an account receivable, in other words, paying later, or it could be in the form of receiving some other type of good or service. Then the last key point is you have a sale and you have an associated inventory cost that are recorded simultaneously, and generally the time of the sale is when the inventory is delivered to the client. In the second category of revenue, we'll think about rendering a service. The firm is selling a service to a customer in exchange for some form of compensation. Again, that can be cash, a future cash payment, or the delivery of some sort of goods or services. Recognizing revenue in the case of rendering a service is a little more difficult. So you have to carefully look at the service and come up with a criteria. The criteria could be when you collect the cash. It could be when some specific aspect of the service has been provided. It could be proportionate. In other words, when you've prepared or delivered a certain percentage of the hours of service you provided. Or it could be when the service is completed. Now we'll look at the kind of revenue that you can earn when you permit someone else to use your asset. So let me give you some examples. One example is a loan. You're lending out some of your money, that's the asset, and the revenue that you're earning in exchange is interest revenue. A second way you could permit someone to use your asset is to rent it out. For example, you could rent out a fixed asset, a building, a machine, some space, and in exchange, the revenue you will earn is rental revenue. A final example could be that you are renting out or letting somebody take advantage of an intangible asset you have, such as a patent, a copyright, a trademark. In that particular case, the kind of revenue that you earn is often called royalty income or revenue. The final category of revenue that I want to talk about is what happens when you sell an asset that's not an inventory. You could be selling a financial investment, a fixed asset, an intangible. You're going to be exchanging that asset for some other form of payment, generally cash or stock is the way in which you are paid. The difference between the asset sold and the asset received is recorded as a gain or a loss. So unlike the instance where we sold inventory, where inventory, the revenue associated with that was recorded as $10,000 and an expense of $6,000 of cost of goods sold was also included, they're on two different lines. In the case of selling a non-inventory asset, we will net those two amounts apart. So let's say, for example, we have a fixed asset on our books for $5,000 and someone is willing to pay us $4,000 for it. We would be recording the difference of $1,000 as a loss on our income statement. So now let me walk you through these 4 different types of revenues using a graphic that comes from an older version of Kiso, Wygant, and Warfield intermediate accounting. The first and most common type of revenue is the sale of product for inventory. The type of revenue we have is sales revenue, and the timing of the revenue recognition is generally on the date of sale, which is the time of delivery. The second category is when we render a service. The kind of revenue that we recognize is generally called fee revenue or service revenue, and the services are generally recorded as revenue when they are performed or when they are billed to the client. That can vary based on different criteria. As our third category, we can permit the use of an asset. We could have, by renting it out, interest revenue, rental revenue, or royalty revenue. Those particular forms of revenue are generally measured with the passage of time or as a particular asset is used. And finally, the fourth type of revenue is when we sell an asset other than inventory. We will record as a revenue the gain or loss on sale of that asset, and the date when we will be recording that revenue is on the day that there was a sale or a trade-in. So how do you know exactly whether you can or can't recognize a revenue? That has actually become a very big question, as so many companies are eager to record and recognize revenue as soon as they possibly can. There are so many detailed criteria, I'm not going to go into them at this point. I'm going to hit the highlights, which is their 2 points. Revenues can be recognized. That means shown on the income statement, generally when both of the following things have occurred. 1 is that you've earned the revenue, and 2 is that you can measure it with some degree of accuracy. And so in the case of whether you earned it or not, you need to identify the critical or difficult part of the earnings process and determine whether that has been done. We will look at that now in more detail. So now let's look at the revenue recognition timeline. What you can see is 3 boxes. All the way to the left is the production phase. Then there's the inventory phase, and finally the receivable phase. So if you think about a product, it first needs to be produced, then it becomes inventory, and then it's sold, and the customer eventually pays. So, when should revenue be recognized? The vast majority of instances is when that transition occurs between inventory and receivable. So you can see the arrow indicating, pointing down at that point in between the inventory holding and the receivable holding periods, the sale of goods and services. And so that's when most retail and manufacturing industries recognize revenue. So there is some delayed revenue recognition that occurs after the receivable holdings periods, which you'll see further to the right. So at the end of the receivable holding period, you can see cash collection. And so when a business is brand new, such as a startup, franchise, or real estate development, those are unproven businesses, and there may be some difficulty collecting revenues. And so the revenue collection is considered to be the critical event. And so for those kinds of businesses, also, for example, layaway furniture, the critical event is getting paid. For those businesses, revenue recognition happens when cash collection occurs. In contrast, we can have several different types of early revenue recognition in advance of the sale of the good or the service. So we can think about there being a long-term construction activity, such as the Big Dig in Boston. So you can imagine what would happen if we waited until the end of the decade of construction to have any of those construction companies recognize revenues. None of their lenders or government the agencies that are having them do business would know how successful the construction company is or the financial condition if we did not allow interim revenue recognition. So in the shipbuilding and highway construction, those kinds of heavy construction businesses, we allow an activity called percentage of completion. So you recognize revenues as you go along. Finally, there's another type of early revenue recognition which has to do with commodities. So it would seem a little odd if we thought about it if a company that is successful in mining oil or a precious metal extracted those items from the ground, but had to carry those items on their balance sheet at cost when the rest of the world has the exact same commodities, and those are valued on their balance sheet generally at the current spot market price. So we will allow people in a commodity business to change the value of their inventory up to the spot market if they are the ones that are in the extractive business or the growing business, the agricultural business, creating the product. We had discussed earlier the challenge in trying to figure out revenue recognition when you provide a service. So I'd like to look at a particular example of a firm that's selling a service. So what you can see here is a bundle of services. This firm is selling a client software worth $600, training worth $450, upgrades worth $300, and ongoing customer support for 5 years of $150. So in total, they're selling a package worth $1,500. So the question is, when can you recognize revenue? So the first thing that you need to do is to unbundle that revenue into the 4 different components, and you will come up with a criteria unique to each component. The software for $600 will be an item that's delivered. It's like a product. And so when it's delivered and installed, that software, the revenue recognition will occur. Then you have, as a company, contracted with some of the customers to provide training. You will, as the training is delivered, recognize the revenue for the training. Then you're promising some upgrades. So we're saying it's a value of $300. So as those upgrades are pushed out, say over a 2 to 3 year period, you will be able to recognize additional revenue for having delivered a new and improved product, which is the upgrade. And finally, there's customer support. And in this example, we're saying the customer support is over 5 years. So what that means is the firm will take $30 a year and recognize it, generally spread over on a monthly basis. Month by month, they'll spread that $30 out over the year and say that's the customer support revenue. And so it will be like an annuity recognized in bits and pieces over time, generally equally every month over 5 years. I'd now like to talk about 3 different ways we can recognize revenue. Revenue recognition can first occur at the same time we receive cash. This is called a concurrent transaction. So, for example, you could be running a store, a customer comes in and pays cash for an item. What you would be doing is receiving cash and recognizing revenue at the same point of time. That revenue will then increase retained earnings and the equity in the firm. So this is the first kind of revenue that you can receive. The second situation involves a timing difference. The cash is going to be received before you earn the revenue. So for example, you might be selling a magazine subscription. A customer pays you for the full year of this magazine subscription at the beginning of the year, and then you deliver the magazines over the course of the year. You are not able to recognize the revenue from that transaction until you start delivering the magazines, and the revenue recognition will be prorated across the months of delivery. So we're going to have a 2-step process. Step 1, you receive the cash. It's not yours yet. You haven't earned it. The critical event has not occurred. Therefore, you will record that cash receipt as a liability, as a deferred revenue, meaning at some point in the future, that revenue may be able, that amount of money may be able to be recognized as a revenue. And then in the subsequent periods, as you send out the magazines, you can recognize the revenue. In that case, as you'll see in the red box, what you will record is a decrease in the liability, the deferred revenue, and you'll record some revenue, which will increase retained earnings. So what will happen with this magazine subscription is over the course of a year, you will deliver the magazines. The deferred revenue account originates by going up and then declines, is liquidated, is reversed over the course of the year as you deliver the magazines. And simultaneously, as the deferred revenue liability is decreasing, you are recognizing revenue. At the end of that period of recognizing revenue, that deferred revenue account, that timing difference account that you created, has disappeared, and you will be left with the cash you received being incorporated in your books and the revenues that you earned. So at the end of the second period, when you put those two journal entries together, you will end up net having the same journal entry as you saw up on the top row in the concurrent revenue recognition. Now we're going to look at the third way that we can earn revenue. It's a different type of timing difference. In this case, we're going to receive the cash after we earn the revenue. So in this kind of situation, a customer comes into your store, purchases some items on credit, on account. They agree to pay you later. You recognize revenue today because you've delivered your part. You've sold them the inventory. And at the same time, you record an account receivable, which is an asset, something of value. And then in period 3, the customer will start paying you for what they owe you, and the account receivable will decline, and you will have cash. So at the end of period 3, the account receivable will have disappeared. So again, we created a timing difference account. This one's called an account receivable. We originated it when we sold the item. We liquidated it and reversed it as the customer paid us off. And ultimately, embedded in our books is the cash we received and the revenue that we recognized. And again, the receivable, the journal entry that's left at the end looks like the journal entry we saw up in the top row. We're now going to take a similar look at costs, but I first want to stop and talk about costs because there's two distinctly different types of costs. One's called a product cost, and one's called a period cost. With a product cost, we're thinking about inventory. The main categories of inventory are raw materials, work in progress, also called WIP, and that includes the labor and the overhead that you've added to the raw materials to start making a good. And then finally, the finished goods. These product costs will be recognized on the income statement as a cost at the time that the product is sold. The other kind of cost is called a period cost, which means a cost, rather than being associated with the product that's being sold, is associated with the time period. This includes selling in general and administrative costs, interest, taxes, rent, essentially all the other costs other than what ends up being in the cost of goods sold. So, what happens with these period costs is that we need to identify what was the period in which we received the benefit from those expenses, and we need to ensure that the cost appears in the same time period as the benefit received. We're now going to talk about the criteria for cost recognition. Remember, we had some for revenue recognition, and I just really talked about two very simple basic ones, not the full detailed list of them. The two I had was whether the revenue was earned and whether it was measurable. We're going to have two similar criteria for cost recognition. What's going to be different is the way the test is set up. In the case of revenue, firms are eager to say that they earned a revenue and boost their earnings. So we want to make it difficult, put hurdles in their way to prevent them from rushing ahead and recognizing revenue. In contrast, firms are not eager and rushing ahead generally to put expenses onto the income statement. Rather, what they would prefer to do is to say an expense does not belong in the current period. Instead, it belongs to a future period, and they would like to store it as a cost on the balance sheet as an asset. Therefore, the kinds of criteria that we're going to look at is whether we can deem a cost to be an asset. And so we're going to try to make it difficult for a firm to put a cost onto the balance sheet. So we have two different criteria. First is, did you acquire the rights to that cost, that asset, and are those rights to benefit a future period? And then second, is it measurable? Can we estimate with some degree of certainty what the cost is? We're now going to look at when can we record an expense. Just like with revenues, there are three different timing scenarios. The first is that cash is paid at the same time an expense is recognized. Let's say, as a business expense, one day you take a taxi from your place of business to another location. You pay cash. That's an immediate expense that belongs in this period's income statement. So that would be an example of the journal entry we see here of cash dropping and expense being recorded, which will ultimately reduce retained earnings. Okay, so let's look at the second type of situation. The cash is paid before there's expense recognition. For example, you might put down several months of rent, give it to the landlord in advance of occupying a space. Cash will have dropped in that transaction, and you will have created a timing difference account called prepaid expense, which is an asset. And then as you occupy the space in periods 2, etc., you will start moving the costs that were on the balance sheet as an asset, reducing the asset, moving that cost into an expense, which will then reduce retained earnings. Ultimately, at the end of the time, once you fully use the space, there will no longer be any prepaid expense, and the journal entry that will be left in your books is a decline in cash and the expense of renting that space. That journal entry is just like the journal entry up on the top row. Finally, the third possibility is that the cash is paid after there is expense recognition. In this particular case, what you would be doing is creating a balance sheet account, a liability called an account payable, or it could be called an accrued expense. So for example, let me use the example of a salaried employee. You're going to be recognizing at the end of the month that you owe the employee some money. However, you might pay the employee every Friday, and the end of the month was Tuesday. So you would book a journal entry today that says, I have a liability, I owe this employee money, I have wages payable, and at the same time record wage expense on the income statement so that the wages earned in the present month, let's call it August, are ending up in the August income statement as a period cost. Then in September, which is in Friday, it will be September, when you pay the employee, cash will drop and that wage payable will disappear. So that's the third kind of timing situation you can have in the case of expenses. So I want to move now to the situation of looking at the layout of an in good form income statement. So in this example, we're looking at Apple Computer, Apple Inc. So you would have the name of the firm, Apple Inc., and then you would also have the name of the schedule. In this case, it's an income statement, and the title they've given it is Consolidated Statements of Operations. The third thing that you need to say is, what is the time period? And so for an income statement, we need to know the length of the time period involved. So these are the years, so the 12 months, ending, for example, on September 27th, 2014. So one thing to note is the newest year is stated first and the later years come after that. You also need to denote the currency as is shown here with the dollars. And you'll see up in the top it also says in millions, except numbers of shares which were reflected in thousands. I actually left off the earnings per share portion of the income statement to make it simple, so we're not seeing any per share data. But what Apple is communicating is you should interpret every number on this page as appropriately having 6 zeros stuck after them, because all the numbers being depicted here are in millions. There is some theme and variation in how you present an income statement. I'm going to walk through the most multi-step income statement version that can be done. So I'll show you here right now. You start with net sales at the top, followed by cost of sales. Those are the product's costs, the direct product costs associated with the net sales. And then you'll see a subtotal called gross margin. Sometimes that's called gross profit. That is being highlighted here with a blue arrow to signify that that subtotal, that gross margin subtotal, is optional to provide. The next common grouping is that of operating expenses. So these are period expenses needed to run the basic operations of the firm. In this case, you can see that Apple has 2 types of operating expenses: research and development and selling in general. Again, you can see the blue arrow indicating it's optional at this point to have a subtotal. Most companies do have a subtotal for total operating expenses and also one for operating income. So the operating income is the gross margin numbers. The next section that's offered is generally called other income and expenses. You can find in this section interest, investment income. Sometimes you'll find gains and losses on sales of assets in this section. These are the things that are considered to be costs of doing business, but were not sort of the normal day-to-day operating costs. Finally, we're going to get to an important subtotal, income before provision for income taxes. This can sometimes be called pre-tax income. So it's all the income we earned before taking into account the income taxes we owe. You are required to have a subtotal here, separately depict the income taxes that are due. You can see here the title of the income tax account is called Provision for Income Taxes, but you could also call that income tax expense. Finally, we have the bottom line, net income, which is revenues minus all the various expenses, and you can see it's a grand total with double underbars and a dollar sign in front. Now there comes to be a question from time to time about what to do when a firm has costs that don't regularly recur. So there's 2 different categories of them. One of them is called special costs or unusual costs. The other is called discontinued operations. This is when we get rid of a business or a product line, not when we simply get rid of a single product. You may read materials, even this textbook, that mentions that there's a 3rd category called extraordinary items. Extraordinary items are being eliminated starting in 2016, so I will not be having any expectations that you know or understand or can present any information about extraordinary items. These used to be where we would put things that were so rare and unusual, such as a flood and a hurricane, that we would put those things into this special different category. It's become so difficult to determine what kinds of items might be put in this category that the FASB has decided to eliminate this category. Let's now look at the 2 ongoing types of non-recurring items: special or unusual and discontinued. Examples of special or unusual include gains or losses on fixed asset sales, gains or losses on financial investments, and restructuring expenses. For a discontinued operation, you would need to be selling a business, a subsidiary, or a very distinct product line, or you could be dissolving and getting rid of some kind of major component of the business. How these 2 things are depicted varies, and so in the case of special or unusual items, you're going to display those numbers without directly including in those numbers the tax effect. On the other hand, with the discontinued operations, you're going to compute the gain or loss on those particular activities and then embed into the number you report the tax effect. You're going to display, in the case of a special or unusual item, you're going to display these amounts up in the main body of the income statement, generally in with other operating expenses. In the case of discontinued operations, we want to make sure the reader of the financial statement is aware that these operations will not continue. So we're going to pull them out separately and show them at the very bottom. And we're going to disaggregate two different things. One is we're going to compute the ongoing revenues and expenses from that discontinued business. We're going to have like a little net number, if you will, revenues minus expenses. We're going to report that number. That's from the ongoing discontinued business. And separately, we're going to report the gain or loss on the transaction involved in selling the discontinued operation. Now let me present the Procter & Gamble income statement in good form and point out how it varies from Apple's in a few important regards. Procter & Gamble has both special and unusual items, and it has discontinued operations. So the first thing that you can see highlighted with the blue arrow is the top section, where the firm has elected not to present a gross profit subtotal. What is depicted right after net sales is the cost of products sold and the other operating expenses. In there, you can see two non-recurring expenses that are special and unusual. One is called goodwill and indefinite-lived intangible asset impairment charge. That's a mouthful. And the other is the Venezuela deconsolidation charge. Both of those are considered to be special and unusual charges, so they're presented this high up on the income statement, and the numbers being presented are gross numbers. The tax impact of each of those is not incorporated in the numbers. You can see that operating income is being presented, but they've chosen not to present a total operating expense subtotal. And below that, they have broken out interest expense, interest income, and other non-operating income. Then they have a subtotal we haven't seen before, which is a mandated subtotal called earnings from continuing operations before income taxes. This is the name of the account that you will want to use instead of what we saw before, the pre-tax income account, when you have both continuing operations and discontinued operations. What you can see immediately under that red arrow is an account called income taxes on continuing operations. That's the income taxes associated with the number right above it. So the $2,916,000 are the income taxes being charged on the $11,846,000 in earnings from continuing operations. So, if Procter & Gamble had not discontinued an operation, the subtotal we see, net earnings from continuing operations, would instead be labeled net income, and that would be the end of the income statement. Instead, because they do have a discontinued operation, we have a line called net earnings / loss from discontinued operations. What that is the part of the discontinued operations that is the revenues minus the expenses from the ongoing operation itself. They would need to separately break it out if they had sold the discontinued operation for loss.